everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Codify. Today, we're going to look at our April 2025 update on FINRA's margin debt data. Margin debt is the amount of money an investor borrows from their broker via a margin account. Trading with margin debt can magnify gains, but can also exacerbate losses. A high level of margin debt might suggest that investors are feeling optimistic and are willing to take on more risk to increase potential returns. So they borrow more to invest because they believe the market will continue to rise. But it can also be a warning sign because it means there's more leverage in the market. And if the market takes a downturn, it could lead to more frequent and more severe margin calls. On the other end, lower levels of margin debt often suggest cautious or even pessimistic investor sentiment. People might be less willing to take on debt to invest, perhaps anticipating market volatility or a potential pullback. While lower leverage can be seen as a sign of reduced risk in the market, it can also indicate missed opportunities if the market were to experience significant gains. Now let's take a look at the relationship between margin debt and the market using the S&P 500 as our benchmark. This first chart shows the two series in real terms, adjusted for inflation using the CPI as the deflator. In some of my previous videos covering margin debt, I pointed out a few interesting patterns along our time frame. In short, notice the relationship between significant increases in margin debt, the purple line, and subsequent market peaks, the green line, as well as the correlation between market bottoms and troughs in margin debt. The latest margin debt data is now available through April. Currently, the debt level stands at $854.97 billion, down 2.9% from March. This marks the third straight month the debt level has declined and is the lowest level since October. Compared to a year ago, the current debt level is up 10.3%, the smallest annual change in the past 15 months. And the debt level is now 8.8% off its record all-time high from January 2025. But when we adjust for inflation, which is what our charts show, the debt level was down 3.2% month over month and up 7.8% year over year. Again, this is the third consecutive monthly decline and the smallest annual gain in the last 15 months. And the real margin debt level is now 21.2% below its real record high from 2021. Now here we have the same chart as before, but margin debt is inverted. This makes it easier to see the relationship between the two series. This next chart shows the growth of the two data series starting from 1997. Again, this is based on inflation-adjusted data. It's clear to see that the growth among the two has always moved in similar patterns, albeit not similar rates. Early on, margin debt and the market grew at comparable rates, but started to widen during the tech crash recovery in the early 2000s. The gap has narrowed recently, but remains fairly wide. As of April 2025, real margin debt has grown nearly 310%, while the market has grown just over 250%. Now, Lance Roberts of Real Investment Advice analyzes margin debt in the larger context that includes free cash accounts and credit balances in margin accounts. Essentially, he calculates the credit balance by adding free credit cash accounts and credit balances in margin accounts, and then subtracts margin debt. This chart here illustrates the mathematics of credit balance, and it overlays the S&P 500 with it. Note that this chart is based on nominal data and is not adjusted for inflation like our previous charts were. The latest net credit balance is at negative $486.8 billion, its highest level in 6 months. Now here's a slightly closer look at the data starting in 1995. I've inverted the investor credit monthly data and used markers to pinpoint key trading points. Again, with the inversion, it's easier to see the relationship between investor credit and the market. We see that the troughs in the monthly net credit balance preceded peaks in the market by 6 months in 2000, 4 months in 2007, 4 months in 2018, 2 months in 2021, and 0 months in 2025. Margin debt isn't a perfect predictor, but it still is an interesting indicator to watch as it can offer insights into the collective risk appetite and overall sentiment of investors. With that said, the data is several weeks old when published, so major shifts are not immediately visible. That's all for our latest margin debt update. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.